If you are serious about becoming a profitable trader, stop searching for signal and learn how to analyze the market yourself. Technical analysis is one of the foundation of every successful trading strategy, and without it, it's more like you doing the guesswork. If you are new here, my name is Yemreg. In my previous lesson, I spoke about Forex basics and how to use trading views. So in today's lesson, I'm going to be talking about technical analysis. So let's get straight into the session. Now we are here. Technical analysis is the process of studying price charts to identify patterns and trends that can help us make trading decisions instead of relying on opinions or predictions. So that's what technical analysis is all about. It's just the study of price actions, price movements. So you literally use it to know the historical price movements of the market. Without this, you'll be doing more of a guesswork, and that's why you should know how to analyze the markets yourself. So now let's get straight into the section. So the first thing you need to know here is candlesticks. Candlesticks is a chart, right? You literally have different types of charts. We have line chart, bar charts, and the rest. You can see them here. But the most used one is candlestick. And a candlestick comprises of what we call the body and the wick. And here is an example. As you can see on the screen, this is a candle, this is a candlestick. This long red line or red box is a candle. So the thick part of the uh box is what we call the body. This thick part, I'm going to circle that right away. This thick part is what we call the body of the candle. Here is the body of the candle. Why this styling line attached to the body of the candle is what we call the wick. The thick is the body. Why body? Why the one attached to the wick is to the body is a wick. We can also call it shadow or shadow, any one of the two, right? And how do you differentiate a bullish candle from a bearish candle? Because there are different between two of them. You can literally use the color combination of your charts. Like personally, I am using red, as you can see. So the red candle represents a bearish candle, while the green candle represents a bullish candle. So the green candle is a buying candle, while the red candle is a selling candle. So now, if you want to differentiate between the two, a bullish candle opens from the bottom and closes at the top, while a bearish candle opens from the top and closes at the bottom, right? And the highest the candle has gotten to is what we call the high. This is the high part of the candle. This place is the high, while this place is the low. So we have the high, we have the low, we have the open, and we have the close, and we have the body of the candle. So those are the characteristics of a candlestick. If you are still having issues with this, you can make reference to my video on candlestick. So without delay of our time, let's get straight into the most important thing you need to know first as a technical analyst. So now one of the most important thing is knowing the direction in which the market is heading, which is what we call trend or market structure or directional bias. So we literally have three types of trend in the market. We have a bullish market, a bullish trend, we have a bullish trend, we have a bearish trend, and we have a sideways trend. Those are the three trends we have in the market: sideways, bullish, or bearish. So whenever the market is moving to the up direction, we call it bullish. Downward direction, we call it bearish. While sideways, when the market is just moving sideways, we call it consolidation. And sideways is when the market is giving equal numbers of sellers and buyers, or equal supply and demand. So you also use trend line to know the direction in which the market is heading. So before I go into that, I'll show you guys how to know if the market is bullish. So whenever the market is giving an upward movement, just as we can see on the screen, or we are having more of bullish candles, right? Or we are having more of bullish candle. That means we are having more of buying candles or green candles here. So we have more buyers and sellers. That is why the market is moving to the upward direction. Starting from this bottom, now this is where the current price is. So this is obviously what a bullish markets. The market is moving to the up direction. And how do you know a bullish market? A bullish market comprises of what we call the highs and the lows. And remember, in my Forex basics, I spoke about buying low and selling high. So in the Forex market, you buy at the bottom, you buy from here when the market you buy from here when the market is moving to the upside, So you buy low and you what? You sell high. So now in the first market, you buy low, and this is the low part of the market, and you sell high. So you buy from the bottom, you sell at the top. This can also be called support zone, and this can also be called the resistance zone. So this is where sellers are in charge. This is when sellers are taking charge, and this is when buyers are taking charge. So you buy from the bottom and you sell at the top. So in a bullish market comprises of highs and lows, highs and lows. So one thing you should know in the market is that the market doesn't just move to the opposite direction without having highs and lows. The market is always creating series of highs and lows whenever the market is in place. So the market doesn't just give a straightforward movement, just something like this. Maybe like this. The market doesn't just give a straight up movement. No, the market is always moving in a zigzag format. So it all creating series of highs and lows, highs and lows. So the market doesn't just move like this. We are always having something like this. We're always having something like this in the market. So the market is always moving in this direction. The market doesn't just move in this direction, it's always moving in this direction. The only time you see markets moving in this kind of direction or something like this is when there is news, right? When there's high volatility in the market, that's when the market just spikes to the upside or pump to the upside. But in normal, the market is always creating series of highs and lows. And remember, I said we buy from the bottom and we sell at the top. And this bottom area is also known as the support area or the low part of the market, while this high area is known as the resistance or the high part of the market, right? So now, how do you know if a market is bullish? If a market is giving a bullish trend, that is very simple and straightforward. So let me try to clear this out. So that is very simple and straightforward. In a bullish market, the trend give us series of highs and lows, like I said earlier, something like this: highs, lows, high, low, high, and low. So in the bullish market, the market is always creating something like this. It's always giving something of this nature, right? Creating what we call series of highs and lows. So in a bullish market, how do you know that this is a bullish market? A bullish market give us series of higher highs and higher lows. You might be wondering what is called higher highs and higher lows. Don't be scared. I'm going to explain that in detail. So we have what we call the higher high. So I'm going to be representing that with HH, and we have what is called the higher low. And remember, this part is the this is the low part of the market, low, and here is our what? Here is our high. And remember, I also said you can call it resistance, and this piece is your what? Your support. So in a bullish market, let me try to take in this so that you guys all can see it more clearly. Let me put it in. Let me take in it. So I think it's more clearer now. Think it's more clearer now. So in a bullish trend, a market creates series of higher highs and higher lows, and these are the high, these are the lows. And the reason this is called higher high or higher low is because this high is higher than this previous high. So this part of the chart is our higher high, and this part of the chart, the downside is our higher low. So that is our higher low, because that's the bottom part of the chart. This is the low, this is the high, this is the low, this is the high, this is the high, this is the low. So this place is our higher low, sorry, higher high, and the other one is also the higher low. Higher high, higher low. And the reason this space is called higher high, like I said earlier, is because this part of the chart, and remember what I showed you guys here, this is the high part of the chart. So this part is the highest part, the highest point the market got before it started dropping to the downside. So this is the area where sellers came in. And remember, this is a buyer's market. This is a bullish trend. And this line is representing a count. This is just an illustration. So this part is the highest point the market got to before it started moving to the downside and before it started moving to the upside again. So this is how the market is always moving. It's always giving this wave-like movement, not just a straight line movement. So this part is the highest point the market has gotten to before it dropped to the downside. So this part in a bullish trend is known as the higher high because it is higher than the previous high. This part is known as the higher low because is lower, sorry, is higher. This low is higher than this previous low. This low, remember, this part of the chart is the bottom part of the chart. So this low is higher than this previous low. Same also go for this one. So the higher the market goes, the higher the other ones will be higher than the previous ones. So this is higher than this. This is also higher than this. So you can literally label this. Let's label it 1, 2, 3. So this is 1. This is 2. I'm going to label that part 2. And this is 3. Right? So no, I number 2 is higher than I number 1. I number 3 is higher than I number 2. So you can see it that way. Same thing also go for low. Low number 3 is higher than low number 2. Low number 2 is higher than low number 3. And now this, if you look at this cross bar or this cursor, they are not on the same level of support. This place is not on the same level of support with this place. So this support is higher than this previous support. This support here is higher than this previous support. So that is why it is called higher low. Same thing also goes for this one. This high, this resistance is not on the same level with this resistance. This resistance is not on the same level with this resistance. So this resistance is higher than this resistance. Resistance number 2 is higher than resistance number 1. Resistance number 3 is higher than resistance number 2. So that is why it is called higher high. Higher, and it continues like that until there's something we call shift, until the markets will start moving in the opposite direction, which is going to be bearish trend in this case. So in my market structure class, I'm going to share more light on this. I'm going to explain more in detail. So this is just the basics, right? Now moving on, let's talk about a bullish trend. A bullish trend comprises of the opposite. A bullish trend also comprises of the highs and the lows, highs and lows. So this is an example of a bullish trend. Sorry, a bearish trend rather. A bearish trend. So a bearish trend comprises of highs and lows also. So in the bearish trend, we have what we call the lower highs and the lower lows. The lower highs and the lower lows. And where are the lower highs? This is the lower high. The high part of the market is the lower high, while the lower part of the market is the lower low. So this is our lower high and this is our lower low. So we are going to label that LL. So let me try to clone this. So lower low, lower low, lower high, lower high, lower high. And don't forget this other side. Lower low. So this is a bearish trend. So let me try to label this for me. Bullish trend rather. Bullish trend. Why this other one is bearish trend. So in a bearish trend comprises of highs and lows, highs and lows. So this part is the high, this part is the low. Now, why do we call this space lower high? This high is not on the same level of resistance with this other high. So high number 1 is not on the same level of resistance with high number 2. So obviously high number 2 is lower than high number 1. Same thing also go for the third one. High number 3 is lower than high number 2. High number 4 is lower than high number 3. So that is why it is called lower high. So this high is lower than this previous high. This high, this high is lower than this previous high. This high is also lower than this previous high. That is why it is called lower high. Same thing also go for the low part of the chart. So this low is not on the same level of support with this other low. Same thing also goes for this part. This low is not on the same level of support with this low. This low is not on the same level of support with this low. So this low is lower than this low. This low is lower than this low. This low is lower than this low. So that is why it is called lower low, because they are lower than each other. That is why they are called lower low. So in a bearish trend comprises of lower high and lower low. In a bullish trend comprises of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. So this is how to know if the market is moving to the up direction or moving to the down direction. So this is a uptrend and this is a downtrend. And remember that in a bullish trend, we also have buyers, but there are more of sellers than buyers. That is what it's trying to tell you. In a bearish trend, we have more of supplies or suppliers than demand. So in a bullish trend, we are having more of demand than supply. So demand is the buying part, while supply is the selling part. So that is why when they said bearish trend doesn't mean it's just sellers. We also have buyers inside of it, but just less of it. See it as 70% of people selling and 30% of people buying. That is what it's trying to tell you. And you can also use what we call trend line to know this. So there's what we call trend line. So you use trend line to know the direction of the market. So how do you do this? You place it on the point of rejection. So these are the point of rejections. These lows, this low part of the market are the point of rejection or the peak points in the market, where the market started reversing to the upside. So we have the bullish trend line. So there are some traders that use this as an indicator or as a strategy to know when to buy or when to sell. So people that use trend line as a strategy, they can literally buy from the peak points. Like a valid trend line now, it's from the third touch or the third peak. This is the first touch, this is the second touch, and this is the third touch. So you buy from the bottom of the third touch. That is the peak. So you buy from here in a bullish trend. So most times you buy in a bullish trend, you don't the sellers. There are some people that sell. Selling in a bullish trend is more like you counter trend. You are going against the trend. And if you are buying a bullish trend, you are going with the trend. That is pro trend. So also same thing goes for here. If you are buying in a bullish trend, you are counter trending. But if you are selling, you are going on a pro trend. So you can also apply the same trend line here. So you draw it across the peak points of the chart, and they have to connect. There are some situations whereby they might not connect. There are some situations whereby they might not connect. So this is a strategy for some people. I personally, I don't use trend line, but it's very important to understand what it's used for, because most times it's used as a support or resistance zone. So in this case, this is a support trend line and this is a resistance trend line. So it's showing you the areas where we are having more concentration of buyers, the areas where we are having more concentration of sellers. That is what it's trying to tell you, right? I personally, I use SMC. So you should have the basic knowledge of how this works. So I see trend line as a vertical support or resistance zones. Same thing for this one. So that is it. So moving on, we have the third one, which is our sideways trend. The sideways trends comprises of equal numbers of buyers and sellers. Sorry. So a sideways trend comprises of equal numbers of buyers and sellers. So this is how a sideways trends goes. So in a sideways trends, we are having what we call equal highs and equal lows. So these are the parts, these are the equal highs and these are the equal lows, because there are equal numbers of they are on the same level. That is why it is called equal highs and equal lows. So we can call this EQ, equal, sorry, EH, equal high. So all these points here is equal high, is equal with this. They are on the same level of resistance. Same thing also go for the part, down part, equal low. They are on the same level of support. They are on the same level of support, and they are on the same level of resistance. So this happens when there's equal numbers of buyers and sellers in the market, or equal supply and demand in the market. That is why we do have something like this. So in this situation, you try to stay away from the market. You don't do anything. Wait till we are having the clear direction. So like this now, we are not having any clear direction. So wait till you have a clear direction, either to the upside or to the downside. So in this case, may I have something like this, whereby the market breaks through this support area of the market of the chart. We can have something like this, something like this, or we can also have something like this. Either ways, so you wait till there's a break of this support zone or this resistance zone before you can start selling or buying. So it's advisable to always wait for a break before you make any decision. So this is the resistance part of the chart, and this is the support part of the chart of the market, right? So price is in equal high and equal low. So equal numbers of buyers and equal numbers of buyers and equal numbers of sellers. So they are more like they are in tug of war. So remember, this is your resistance zone and this is your support zone. Same thing also good for the bullish trend. So this area of trend line, this place I do this trend line, they are the support zones. While these areas I do this trend line, they are the resistance zones. So you buy from the support, you sell from the resistance. So in a bullish market, you look for buy opportunities. In a bearish market, you look for selling opportunity. So don't do counter trading, especially if you are still new in the market. If you are still new to forex trading, I would suggest you always go with the trend. The trend is your friend. Do more of trend trading or pro trend trading instead of doing counter trend. Counter trend is when you are going against the overall trend. And another thing you should understand is how to navigate on time frames, because what you are seeing here, the varies on the time frame. Market structure is fractal, or trend is fractal. It's fractal in the sense that this candlestick you are seeing here on the charts, they represent different time frame. As you can see, they represent different time frame. These candles you are seeing here, they represent different time frames. They are formed in different time frames. So this candle here, they are formed on different time frame. Each candle here represent the time frame you are on. So presently I'm on 4 hours time frame. So this is 4 hours. So each of these candle represent 4 hours. So it is also very important you know how to navigate on the time frame so that you can know the overall direction of the trend. In my next video, I'm going to be talking about market structure in detail. So I'll explain to you guys how to read the structure like a pro. So these are the important things you know in technical analysis: how to read candles, uh, support and resistance areas in the chart. So this is the support area, this is the resistance area, and in a bullish market we have highs and lows. So in a bullish market we have what we call higher highs, higher lows, higher highs, higher lows. In a bearish market, we have what we call lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and the rest. So it is very important to also have a strategy that works with all these other things. So in the course of this class, I'm going to be talking about SMC. So I use SMC to trade. So that is it. So that will be that for this part. Moving ahead, let's talk about time frame. So we have different time frame and they are for different purpose. We have the higher time frame, we have the lower time frame. So the higher time frame talks about the overall direction in which the market is heading, and while the lower time frame talks about the internal direction, like the temporary direction in which the market is heading to at that point in time. So let me try to clear all this out so that we can focus on the, sorry, you can literally come here and remove all the old drawings. and focus on the charts. And now, as you can see, this is this is a day one time frame. We are currently on day one time frame, and this is what we are viewing at the moment. I remember in my previous video I spoke about navigation, I spoke about POV. So my present POV is starting from here because this is what the chart is showing me. This is what I can see on the chart. So now, for the purpose of this session, I would love to focus. So this is what the chart is showing me at the moment. So I would love to focus on this part of the chart for better explanation. So let's start from here. So I'm going to navigate and zoom in that part of the chart. So now, this is the one time frame, right? So if you take a look at this, this is May, and we are currently in July. So I would love to focus more on the most recent data here. So let's start from here. So starting from here, we are going to start from this swing high. We are going to start from this swing high. So let's start from here, this swing high and this low. So taking a look at looking at this is what obviously a bearish structure. Starting from that place I highlighted earlier, this is what a bearish structure. Starting from here down to this side of the chart. But now we are having a straight candle. This candle is so big that there's not much to what we can see on this candle. So that is where your time frame comes in. That is when you start navigating through different time frame. But before we do that, let's try to zoom in that part of the chart so that we can have a proper view of the trend. So on the higher time frame, we'll be able to figure out that this is a bearish structure. Starting from here, remember we are not focusing on this part of the chart yet. This is where we are focusing on at the moment. We are focusing on this portion of the chart. So looking at this is what a bearish structure starting from this swing high to this swing low. And the candles we are seeing here, they are bearish candles, they are big bearish candle. So for us to see more into this candle, because this candle is too big, there's no much details in this candle. So for us to see more into this candle, we need to go to the lower time frame, which it could be 6 hours, it could be something lower than the one you are on at that moment. So I'm currently on day one, so I would love to go to 4 hours. So this is my time frame. This is how I navigate on the charts using this time frame. And this time frame represents different functions. This first three time frame talks about, it shows me the overall direction, the higher time frame or the overall direction in the markets. We can literally have different direction depending on the time frame you are on. So that is why they said market structure is fractal. So these three time frame, week one, day one, 4 hours, I use them for the overall direction or the higher time frame bias. So this is what it's showing me. It's currently showing me a bearish structure according to this part. So if I'm to focus on this part, this is what a bullish structure. But this is where I'm focusing on at the moment, right? So now, and if I'm to also focus on the overall view, according to what I showed you guys earlier. So let me try to zoom in. From the overall view, we are having a bearish direction. And this overall view is like a month's worth of data. So that is why your POV matters. Once you are able to figure out how to navigate, having a better POV and all that, you know when to see opportunities in the markets. Because if you don't know how to do this, you end up missing trades or taking the wrong entries and all that. So it is very important you know how to navigate as a trader or as a technical analyst, right? So now let's move to the 4 hours time frame. I remember I already circled this portion of the chart. So let's move to the 4 hours. So we are currently on 4 hours and it's not showing us that part of the chart I circle. So that's when the zoom out comes in. So you zoom out from here and now we are having this. So this is what a bearish structure. So in this bearish structure, price is giving us series of highs and lows, and I'm going to show you guys that. But we can't see it more clearly on 4 hours because the candles are still big. So let's go to 2 hours for us to see it more clearly. So moving to 2 hours, this is what we are going to be seeing, viewing. So this is what we are going to be viewing on 4 hours. So on 4 hours, this is what the market is showing us. So starting from here, let me try to clear all this out. So starting from here, this is a swing this is the coming. So starting from here, this is the highest point the market got to before it dropped to this side of the chart. So the price gave us series of highs and lows, series of highs and lows. And where are the highs? So this is we have one high here. There's a particular there's another high here, another high here, and there's another high here. We're having another high here. And where are the lows? There's a particular low here. And don't forget there's a particular high here too before we have another high here. And sorry, another low here rather. So this is the low 1, low 2, low 3, low 4. So these are the lower lows and this part is the lower high. So let me try to zoom in very well. Let me try to adjust the chart so that we can all see it more clearly. So that is our what? Our lower high. So I'm going to label that right away. So this is our lower high. And this is our lower low. So this is our lower low and this is our lower high. So I'm going to take off this drawing, our lower high, and that is our lower low. Same thing also go for this part. This is our lower low and this is our lower high. And it goes on like that. See, we have a shift to the opposite direction. So this is our lower high. So this is our lower high, lower low, lower low, lower high. And we can also use this indicator or this to indicate that. So the price move from here to this part, then drop down to this part, giving us this lower low, then give us this lower high, came down, give us this lower low, give us this lower high, came down again and give us this lower low, and give us this lower high, came down, and now you can't call this place a lower low because there's a low that is lower than it. So they are not, this is not a lower low anymore, right? Because it is not lower than this previous low. So you can't call this part of the chart a lower low. So the market has literally shifted on the lower time frame. If we were to go to the lower time frame, I think there's a shift there. So this is not what a lower low. This is already giving what's it called? So this is not a lower low. So you can't call this a lower low. So automatically the fact that you can't call this a lower low, you can also call this a lower high because there is a particular higher than this high. Same thing also good for this one. So these parts, according to this view we're having, their internal structures. So these parts are invalid. So you can't call this place a lower high. Again, you can't call this place a lower low because there's a particular high that is higher than all of them. So obviously this is going to be our lower high because it's not on the same, it is higher than this one, it's also higher than this part. So I'm going to do a correction on that. So it's going to go this way, lower high, then something like this. So let me start it again. So we are going to be having something like this, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So it goes up that way. So you might be wondering that what about all these ones that happens there? These are internal lows or internal highs. So these are internal structures. So we literally have two sides to structure, to a bullish structure, a bearish structure. We have the internal bullish structure or the external bullish structure, or the internal bearish structure or the external bearish structure. So when I release a video on market structure, I'm going to break this down in more detail, right? So this is our lower high, lower low, lower low, lower high. So you can't call this place lower high, you can't call this place lower high. according to this view, according to this point of view. That is why your point of view matters. If we're to be focusing on this part of the charts, or probably we zoom into this part, then you can start labeling this part as a lower high, lower low, lower high, lower low. So that is going to be an internal lower highs or internal lower lows, and that is going to be representing an internal structure. But in this case, this is our view. We are having this view. This view is starting from here. So we are focusing on the external part of the charts of the trend according to this view, right? So these are the areas we are going to be focusing on. So these are the major lows, the major highs. So all these ones are just the minor highs or lows. So they are the internal lows or highs. And remember that this area are also called the resistance areas. This is also called the support area. This is the support, this is the resistance. But according to market structure, according to directional bias or the trend of the markets, we call this space lower highs, lower lows, lower highs, lower lows. The traditional support and resistance says we sell or buy from the third touch. So this is an example of how support or resistance works. So we buy or sell from the third zones in the market, where we're having something like this. When the market tests a particular zone like 3 times, this is the first touch, the second touch, then the third touch. So we sell from here, from the third touch. That is for a resistant zone. And this is mostly used for when there's equal highs or equal lows in the market, when the market is consolidating. But in a trend market, in a trending market, and this is an example of a trending market, a trending market is always giving lower highs and lower lows, lower highs and lower lows. So in a trending market, it is advisable to use trend line. So in this case, you draw a trend line instead. Coming. So in this case, you draw a trend line instead. So this is a trend line. So you sell from the third touch. In this case, it is not aligning. So it's more like you forcing it. So don't force your trend line. So you can literally go this way. So they have to be like in alignments with the touches. They have to be equal. So I don't use this for entry. I just use this for to know if the market is bearish or bullish. But there are some traders that use this to take sales or buys in the market. But it's also very important to have the basic knowledge of how they work as a technical analyst. So it's very important. Even though if you don't use trend line or support and resistance, you don't use them as your strategy, but it is very important you understand how they work, right? So now this is lower high, lower low, like I said earlier. So this is a bearish structure, a bearish structure. And now all this move that happens from year to year, from this low to this high, they are caused by bias. So this is like a pullback. This is what we call pullback. So the markets move back from year to year before sellers eventually take charge and push the price to the downside. So what happened from year to year is a pullback. So as you can see, we are having bullish candles, bullish candles. Then sellers candles now came in and pushed price to the downside. Same thing also goes for this side of the chart. Buyers came in, they pushed price to the upside, but eventually sellers took charge and pushed price to the downside. Now this shows that was buyers are also in charge, but we're having more of sellers. So sellers took more controls in the market. We're having more of selling candles. We're having more of red candles in this case. So that's why it is a bearish structure, right? Same thing also go for bullish structure. So let's look out for a particular chart to explain that. So I'm going to be looking for a bullish chart rather. So now we have a bullish chart here. So this is a perfect example of a bullish structure. So starting from here, the market started moving to the up direction, starting from here. So we're having series of highs and lows, 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 highs and lows. So let's focus on this part of the chart. And now this is where we had this shift to the upside. The moment price took out this high, then we started having a bullish structure. I don't want to go into detail on that. That will be in my market structure class. So here, price gave us this low, give us this high, give us this high, give us this low. So this is our higher high and this is our higher low, our higher highs and higher lows. So it goes this way, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. It goes on like that. So I remember that the next high must be higher than the previous high before you can label it higher high. Just like in this case, let me try to zoom this. Let me try to zoom this. So in this case, as you can see, they are not on the same level. So let me try to draw out the resistance box so that you can see it more clearly. So they are not on the same level of resistance. So this high, and if you are looking, always mark the eye of the candle as your higher high or higher low, the peak of the candle. Now this is the peak of the candle, right? This is the peak of the candle. So always mark it as your area of higher highs or area of high. So that's the high, the highest parts the candle got to. So this space is going to be marked. Same thing also go for this. So this is the what? This is the lowest candle here, or this is the lowest part of the candle. So this space is going to be the higher low, and this is going to be the higher high. So far the wick or the body, it could be a wick, it could be a body. So far it is taller than the previous one, then you can label that place as higher high. And sometimes this wick might be a full body on the lower time frame. So that's where top-down analysis comes in. That is when you start navigating through different time frames to know, to be so sure of this. So this place is the other higher high. So this is the higher high. So they are not on the same level. This is higher than this previous high. Same thing also goes for this part. This is lower than this previous low. Same thing also goes for this part. Now you might be wondering that why didn't I label this place as higher high? No, it's not higher high because this previous one is taller than it, is higher than it. So this place is not valid. So you can't label this place as higher high. So let me try to sample that. So this place, you can't label it as your higher high because see, this one is higher than it. So instead of labeling this place, you are going to label this place as the next higher high, and this place as the next higher low, and it goes on like that until there's a shift to the downside. So this side is the resistance side, and this side is the support side. So that's when trend line comes in. So that's when you can draw your trend line to know the direction of the market, to know if the market is bullish. And remember that trend tells you about the direction on which the market is moving. Either it's moving to the upside, or it's moving to the downside, or it's moving sideways. So this is one of the most important part of technical analysis. So you literally use it to predict price movement, and this can bring up your strategy. From there you can discover your strategy. We have different strategy. We have price actions, we have SMC, we have ICT, we have indicators traders, we have a lot of other forms of trading. So you just need to choose one. And as a technical analyst, it is very important you focus on a particular strategy. Don't trade every strategy you see out there. Do not trade every strategy you see. Just focus on just one. Be consistent on one and master it. And before you can also master this whole thing, you need to practice. The more you practice, the better it gets. So you need to practice very well, because most times traders don't practice, and practice consistently, not just one day or one day on. No, you need to practice consistently before you can get this whole thing right. That's the thing. So that is how the markets move. So now let's look out for a sideways trend, a situation whereby the market is giving a sideways movement. So now here's a perfect example of when the market is giving a sideways movement. So this is an example here. So the market is giving equal highs. So this is the highs are equals, they are equals. So this is the area of resistance, and this is the area of support. You can call this place the area of support. So this is the resistance. So market is in like they are in equilibrium here. We are having equal numbers of sellers and we are having equal numbers of buyers. So that is why we are having something like this. So markets move to the downside, then it's moved to the upside, move to the downside, move to the upside before we eventually add a break. So at the end of the day, sellers won. So that's why we had this push to the downside, and the markets started selling ever since then, starting from that portion of the chart. So this is how the markets move. It's always giving this kind of movement. And this is what we also call the accumulation or consolidation. So whenever the market is giving this kind of movement, it's better you stay off the chart. And now there's something you can also, there's something here I would love to talk about. So what we are seeing here is sideways according to this view. That's one thing you should know. According to this view, what you can see is sideways trend. But if we were to navigate closer or change our time frame, there are some trend inside of this trend. So we can literally have a trend inside of a trend. So that is why they said market structure is fractal or trend is fractal. So if you take a closer look at this, let me try to clear this off. If you take a closer look at this, there's a particular structure that gave us this, that is giving us a kind of a bearish movement. So we had this temporal bearish movement before we had this temporal bullish movement, then this bearish movement. So if you navigate closer, let me do that. Let me try to zoom in. So if you navigate closer, you realize that inside of that sideways trend on higher time frame or higher view, is a what? There's a trend inside of it. So now if we navigate to like 45 minutes time frame or 1 hour time frame, we are going to be seeing this clearly. So remember, time frame works for the candles. So on the lower time frame, you are going to be seeing more candles. So you literally use this to know, to see the market in detail. That's the purpose of navigating through different time frames. And this works for the candles part. The candle is also works for the trend. So use this to know if we are having a temporary trend or what overall trend or a reversal. And one thing you should know is that there's a difference between a pullback and a reversal. So in the market structure class, I'm going to talk about all these other things. So make sure you watch my videos and don't forget to subscribe to this channel to get more of educational content like this. So at the end of the day, the most important thing you should know as a technical analyst is knowing how to navigate on your trading view. So if you are still struggling with this, you can make reference to my video on how to navigate on trading view. So it is very important to know how to navigate on the trading view and also know how to read charts, especially candlestick. Once you are able to get that, you should also know how to read the trend, either a bullish trend, a bearish trend, or a sideways trend. Not only that, you should also know how to put the charts in the right place. Like, what do I mean by the right place? Like having a better POV, a better point of view to know if we are having a overall movement or a temporary movement, if you're having a reversal or a pullback. All these little things are very important because those are the things that are going to make you a good technical analyst at the end of the day. And remember that practice doesn't make perfection. Practice makes improvement. So the more you practice, the better you get at it. So if there's anything that is not clear, or if there's anything I didn't get to talk about in this video, the comment section is open, so you can always ask any questions. And don't forget to subscribe to this channel. So I'm going to be dropping more educational content on how to get better as a trader. So see you guys on the next one. Bye for now.